Monetary policy remains one of the key underlying determinants of market sentiment, and as we move forward with an expectation that the Federal Reserve will be cutting rates, it's worthwhile trying to gauge exactly what sectors historically do well from easing from central banks and how that might play out in the coming months. So in terms of the wider picture from a historical standpoint, I wanted to give you a couple of examples and talk about how it might be different this time and what sectors appear to be tracking relatively well alongside expectations for Fed easing. So first and foremost, this is from BlackRock. This is sector performance after the first rate cut. Remember, this is not the first rate cut, but we did see a significant period of hesitation, of a pause from the Federal Reserve. Now we've seen them kicking off once again. But you can see 1 year on from that first rate cut, generally you see strength in terms of healthcare, consumer staples, utilities. 2 years on, healthcare once again at the top there, consumer staples second once again, then the financials in third, and 3 years on, again, healthcare outperforming consumer staples and financials. So how does this impact sentiment? Well, I would say that the healthcare sector isn't necessarily in a prime spot under Donald Trump from a policy perspective. So I'm not sure about that. I would also say that if you look at this from a perspective of market sentiment, what you're seeing here is a reflection of the fact that by and large, historically, when you see rate cuts, it's because the economy is in big trouble. Think back to, say, 2007, when you saw the financial crisis. The central bank essentially needs to step in to try and rescue the economy. We're not necessarily in that place in 2025. We're in a position where, of course, they tried to drive down inflation by raising interest rates, and now, where possible, they want to try and normalize rates once again. So by and large, they're cutting rates into some element of strength. You might look at the jobs data out of the US and say it's not out of a position of strength, but it's certainly not in a position akin to that in 2007 or around the pandemic. This is very different, and therefore I don't necessarily think we'll see the same kind of move into perceived havens as we might do in the past. So I wouldn't necessarily say that these moves are solely down to the rate cuts. I think they're instead down to the fact that rate cuts typically come alongside periods of economic distress, and therefore you see havens outperforming as a result. The next one, sectors 3 months after Fed resumes easing. Things are a little bit different here. You can see telecoms at the top of the pack. Utilities once again doing relatively well. At the bottom, you've actually got banks and real estate in play here. I think telecoms is an interesting one. We start moving towards the sphere of sort of IT and tech, and certainly that's a theme that I wanted to talk around today as one of the sectors that will do well. Utilities, I think, is an interesting one as well, because whilst, of course, utilities are perceived to be a sort of haven sector, in part because it's not necessarily a high growth sector, but it is one that's going to give you strong dividend returns. Now, of course, strong dividends and reliable performance, even in downturns, means a strong haven sector. But the flip side of it also is that when you see cuts in terms of interest rates, it means that the return, the risk-free return, is less. So you essentially start to see people moving elsewhere within the markets, trying to find returns. If you cut the amount of return you can get from a bond, for example, without any risk, and it's a guaranteed return, if you reduce that return, people start to look elsewhere. In the UK, people would look at, say, fixed ISAs. If a fixed ISA rate is very high, then maybe you just stick with that because we've got central bank rates that are elevated and that's passed on by the banks. But once you see rates cut and you see those fixed ISA returns cut as a response, people look at that and start to think, I can probably do a little bit better. Let's see if I could do something that's relatively safe, but not necessarily just a fixed ISA. And therefore, people start to look at high dividend stocks, and utilities fall exactly within that. So I do think utilities have a role to play within this. And you can see that in actual fact, I think the rate cutting process is part of the reason why you see utilities doing well. Notably, if you look at the average return by market cap 1 year from the first rate cut, generally during periods where we see rates being cut, but we don't see a recession, which is where we are at the moment, you generally see outperformance for large caps over small caps, but both with strong positive returns. On the flip side, if you see the recession and rate cuts, then by and large, small caps again underperform, the large caps outperform. Is probably, quite easy to understand, quite frankly. If the market's collapsing, then those non-profitable small caps are probably deemed to be much more risky, whereas the big caps, it sort of gives you a buying opportunity for some of the names that you might have wanted to buy in the past. Putting it all together, you can see that by and large, around rate cuts, it's the large caps that generally outperform the small caps. And we'll get onto that when talking about the Russell 2000. There's also a note here that we've, of course, seen roughly a 10% decline in the US dollar. And over the 12 months following that, these are the different areas that generally do well. You can see gold at the top of the pile here on the left, 24.7% return over 12 months. And we have been seeing that, right? We've seen very strong returns in terms of gold, more recently sort of coming into question a little bit, but that's notable. Then you see bonds, equities after that, alternatives, cash at the bottom pile. Then you see strength in terms of emerging market equities, emerging market bonds, and alike. So let's just look at some of these charts. And I've utilized the US 2-year yield as a sort of proxy for where markets believe interest rates are going to go. The short end of the curve in terms of treasury yields will give you a closer correlation to market perception for rate cuts, whereas the back end of the curve is more related to what the perception is around the stability of the underlying economy, let's say. So the US 2-year yield here, I've got it overlaid with the utilities sector as highlighted by the iShares ETF. And you can see here that over the course of this year, by and large, we have seen a pretty close correlation. You do have periods where it becomes inverted. Now, bear in mind, I have already inverted this chart. So when we're looking at upside in terms of yields, which is the US 2-year, which is the blue line, in actual fact, that's it coming off. So essentially, when we have expectations of additional easing from the Federal Reserve, so we're seeing strength in terms of utilities. So that plays into that narrative that utilities do well when you're expecting additional rate cuts. The caveat here, of course, and the caveat behind this whole thing is that markets already priced in rate cuts at the back end of 2025 and increasingly for January, right? So the adjustments in terms of this US 2-year, for example, and essentially market expectations will be adjustments relative to the expectations at that point in time. So if it's more likely we're going to see a rate cut in January than we'd previously perceived because of the data, then that should shift the 2-year yield. It's not to say just because we're going to see a rate cut or we think we might see a rate cut, if the expectation remains steady, then essentially the 2 years is going to continue to drop. That's not necessarily always the case. So certainly as we move forward, if it becomes more likely we're going to see additional rate cuts, then we likely see additional downside for the 2-year yield. And then you see here, because of the inverse correlation, you see the possibility of upside in terms of the utilities. Real estates is another interesting area. Of course, generally, you're looking at lower yields providing cheaper mortgages. It means the possibility of elevated demand in the real estate. So it would make sense that they do well. Now, the caveat to that is a lot of the time when you see downside in terms of yields is because the economy is in trouble, right? It's not just an inflation story. And that is the case in the US at the moment. There are question marks around what's happening in terms of the direction of travel for the US jobs market. And therefore, there's, of course, knock-on implications in terms of the demand picture. So if we see, say, inflation coming down in a meaningful manner and the jobs market picking up and the Federal Reserve saying we're happy to cut rates despite the fact that the jobs market's picking up, that is a more advantageous position because you have economic strength, so strong demand, and at the same time you're seeing downside in terms of yields, and therefore you're seeing mortgages becoming cheaper. So at the moment you are seeing the possibility of upside if we see lower yields, but we're not necessarily seeing that breakout at the moment in terms of the real estate sector, in part because of the concerns in my mind around the US economy. Then you've got IT, which essentially wraps up your big tech names and essentially growth, right? And key to this is the fact that market perception around rate cuts is that we're going to see, additional liquidity flooding into the market. People don't want to be in bonds anymore. They want to try and chase yield, and they get into the equity markets. And if you're going to get into the equity markets, where are you going to go? I mean, number one place you're going to go is big tech. If you're jumping on an S&P 500 tracker, for example, that's going to be heavily weighted towards big tech. So a lot of these funds all flow into tech, even if it's not necessarily the case that they are super reliant on yields being low or anything like that in terms of borrowing costs, because generally they don't really need to borrow to the same extent. They're essentially just money-making machines, these big tech companies. But in terms of the flow of capital into equity markets, they're at the front of the line, essentially. So if we were to see rate cuts, it improves sentiment, and it also potentially improves flows away from the bond market and towards equities, which primarily benefits the biggest companies in the index. And you can see that they've sort of been moving hand in hand more recently as well. Consumer discretionary is another interesting story. So again, you have this story around rate cuts. It lowers the cost of finance, for example. If I was to buy an expensive good that might fall under the consumer discretionary sort of banner, you might say that they could take it out on finance, right? Particularly over in the US. And if we were to see lower yields and you see lower interest rates, then you're essentially coming into a position where it's cheaper for people to take on credit, to take on debt. And so that is positive for consumer discretionary. Consumer staples, less so, right? Because that is the kind of thing that people just have to have. Whereas when they're feeling very confident about themselves, let's say their mortgage has gone down in terms of how much they have at the end of the month, they might now suddenly start thinking they could go out and buy that watch, or they might want to go out and buy that fridge freezer or something that they previously had thought they were going to put off until they're in a bit of a better financial position. So consumer discretionary, a potential benefactor from this as well. But of course, you have the caveat here that you've still got those question marks around the economy. So if we see the jobs market declining further as a precursor to the rate cuts, then again, you have the question marks about, if we're seeing the deterioration of the health of the consumer, then it kind of balances against that sentiment around, rate cuts are suddenly going to really improve things going forward in terms of consumer discretionary. So you do have a little bit more of a nuanced argument on that side. And finally, I wanted to bring up the relationship between yields, the 2-year yields here, and the Russell 2000. Of course, small caps, if you cast your mind back to the chart that I showed you at the beginning of all this, small caps generally don't perform as well during periods after rate cuts, whether it's a recession or not, compared to large caps. But you do often see them performing very well when they are in a position that you've seen elevated rates for a very long period of time, and then suddenly you start to see them coming back, but you don't necessarily see a major recession. I do think they're in a relatively good position at the moment. The Russell 2000, roughly 50% of that are not profitable companies, right? So when you've got a company that isn't profitable, they essentially rely on borrowing, whether it's having to issue new stock or having to take out a loan. And so when you've got non-profitable companies and very high interest rates, that's not a great mix, because there's of course increased concern that some of them might go bust, or they keep having to borrow at ever higher interest rates. And so their sort of financial stability is questioned. So once you see rates coming down, that's beneficial for an index that is particularly geared towards borrowing and trying to transition from non-profitable to profitable. That's why you would expect to see the Russell 2000 doing well as you see rate cuts coming into fruition. Of course, there's always question marks around the economy as well and the health of the consumer, but I think the Russell 2000 should do relatively well as we move forward, and particularly if we see the Federal Reserve cutting interest rates. I hope this has been useful for you guys. Of course, like I said, a lot of the time the shifts in terms of sentiment will be shifts in terms of relative outlook, the relative outlook for interest rate cuts. Do we see shifts that point towards additional rate cuts in the coming meetings? Or do we see shifts that essentially see the Federal Reserve with a more cautious approach as we see potentially inflation rising or the jobs market improving, and therefore their need to step in and ease further becomes lessened. So an interesting one. Certainly, we're moving into a period where there's going to be additional question marks over the pace of easing from the Federal Reserve in 2026. Of course, the second half of the year, you're likely to have someone appointed by Donald Trump who's going to be heading up the Federal Reserve, and that could see us ramping up the easing once again. And so we once again come into this question: who are the winners and who are the losers? Well, who are the particular winners? And there's a number of different sectors that stand to benefit from interest rate cuts from the Federal Reserve.